Welcome back to the Investing on the Go podcast, brought to you by Fund Caliber. We take a closer look at U.S. equities today, including the so-called Magnificent Seven, and what an election year might mean for the U.S. stock market. I'm Stacey West, and today I'm joined by Maneesh Bajaj, manager of the Brown Advisory U.S. Flexible Equity Fund. Maneesh, thank you for joining me today.
It's great to be here with you.
Now, this fund is celebrating its 10-year anniversary this month, and it's had an excellent performance. It consistently beats the S&P 500 over 1, 5, and 10 years, which is not an easy thing to do over the long term, outperforming the S&P. So what is your secret? What enables you to continue to outperform? What are the kind of companies driving this?
So there are confluence of factors at play here. The number one, the most important thing is our philosophy. The second is our approach to investing, which is flexible in nature. The third element I'd say is the talented team at Brown Advisory, which supports the strategy, and also the discipline we have related to how we go about investing.
And the so-called Magnificent Seven has seen a lot of coverage, and they make up something around 30% of the S&P market cap now, I believe. So is the US market over-concentrated in your opinion?
So if you look at the headline and your assertion that the markets are concentrated, that seems like the right assertion, where you have these group of 7 to 10 companies, which are nearly 1/3 of the entire market capitalization of the S&P 500. But we shouldn't get carried away just with the headline. And in some ways, the market capitalization of these companies is also a reflection of how big and how profitable these companies are. These companies are serving very large markets, global markets. They have a dominant share. They have high barriers to entry, and they have largely kept competition away. And these companies continue to prosper. They're growing revenue, they're growing earnings, and much faster than the market. So yes, these businesses have benefited both from growing their earnings as well as investors willing to pay up for these earnings. So I hear you when you say that the markets are concentrated. They are. They've never been in this way ever, but they are for good reasons.
And you own a few of these companies, I believe. So can you tell me about one or two of them? What is their appeal, aside from all the headlines?
Sure. So amongst the larger companies, and oftentimes that they're referred as the Magnificent Seven, we own 5 of the companies. Most of these holdings are very long-term holdings of ours. And Microsoft is an example. It is the largest software company that serves both enterprise and consumers. Microsoft is most well known for their Windows operating system, for their PCs and productivity software like Microsoft Word and Microsoft Excel, PowerPoint. But their offerings are much wider. They're into search, they're in gaming, they're in cloud computing. And with every technological shift, Microsoft has made itself only more relevant for their customers. They are very, very big in cloud computing. They have a full stack of hardware and software where customers can run their data centers on Microsoft's cloud. So this is a company which has done really well over multiple decades. Their revenue are more than $200 billion. And they have operating profits of about $90 billion. So which, again, very, very profitable. And recently, Microsoft has been on the news. They have been investing massively behind AI with OpenAI, the investment in OpenAI. And as I said, that Microsoft has been a long-term holding of ours and done very, very well for our clients. The second is Alphabet. And this is a company, again, we all know for its search, very, very dominant player in the search market. And it's not only search, they have YouTube. They also have Gmail. They have also productivity software. Again, a very large company with $340 billion in revenue, generating $100 billion of profitability. This is a business with strong moats, continue to grow their earnings. These are 2 examples of the Magnificent Seven, which we own in our portfolio.
And you mentioned Microsoft and AI, so let's talk about AI for a little bit. How are you managing the growth of AI in the portfolio?
Sure. So the cool thing about AI is that its perks are not just limited to the big tech giants that are pumping out these fancy AI models, like those massive language ones, which we keep on hearing about. It's also going to be a gold mine for companies sitting on treasure trove of unique data. And if you think about companies like Adobe, United Health, Intuit, Uber, Progressive, which are held in our portfolio, all these companies have rich, deep pool of data, which they have been collecting for many years. And they're just beginning to scratch the surface of what they can do with it. So we are going to see new services, we're going to see new products, and many, many companies are going to benefit from this new technology. It's like we are in a beginning of a whole new era, and AI is a kind of a magic key which will unlock all sort of doors for different industries. So we'll see how this space evolves, but we think that we are well positioned. The portfolio is well positioned as AI continues to get adopted and grow.
Is AI throwing up more opportunities for different types of companies? I mean, some of the ones you mentioned aren't necessarily tech companies, AI companies, as you said. So are you seeing more opportunities to address the AI theme outside of direct tech?
Yeah. So as I mentioned, that we have companies that have tremendous amount of data, and over time they will be able to adopt these AI models and leverage the data to come up with new offerings. There is a lot of excitement around AI, and AI is a word which is being thrown around quite a bit on these earnings calls. But I do think it's early. I think, some have seen some analysis where 35% of the companies in the S&P 500, which are talking about AI on their quarterly calls, which has clearly jumped up from, a few years ago. So we'll see how the space evolves, but certainly we expect many, many companies to be taking advantage of AI.
And then I guess my last question on just AI is, do you think that AI is a bubble? Are we looking at the future AI, dotcom bubble situation?
So there is tremendous amount of excitement around AI, and there's undoubtedly generative AI is transformational, and we've never seen computers being able to speak or talk or understand natural language and respond to natural language as they're doing today. So undoubtedly, a lot of money and attention is pouring into AI. We've seen Microsoft invest $10 billion or more than that in OpenAI. And companies that seem to be falling behind, or the perception that companies are falling behind in AI, are being punished by the market. So undoubtedly, there's a lot of excitement. Now, in my view, it's very difficult to know if you are in a bubble or not. And AI is very promising. And if it delivers on the promise, then clearly we are not in a bubble. But if AI fails to deliver on the promise, then we would be in a bubble. But we will only know post the fact. So time will tell whether we are in a bubble or not.
And we've talked obviously about technology for a bit here, and I was expecting more technology on your fact sheet actually when I had a look. So your largest sector weighting is financials. So tell me a bit more about that. What's so attractive about financials in the US?
So yes, we do have an overweight to financials. Now, by the way, our overweight in financial actually happened without us doing anything, and that was early part of 2023 when MasterCard and Visa were recategorized from technology companies to financials. And one day we woke up, all of a sudden the weights had changed in the portfolio, and we had a much higher weight in financials, even though we had made no changes to the portfolio. It's simply the S&P recategorization of these two companies. But even within financials, we have a very, very diverse set of investments. I mentioned to you Visa and MasterCard. We also own Berkshire Hathaway, which is a very large company. And is Berkshire Hathaway a financial company? Is it an industrial company? Maybe even a tech company, because they have such a sizable holding of Apple. And here again, we also have investments in banks. We have a company called First Citizens, which has been a phenomenal stock for us. We also have investments in alternatives, KKR and Blackstone. And we also have a wealth manager, Ameriprise. So these are fantastic companies. They are different parts of the financial services sector, and we feel very, very good about our investments. And most of these investments have done really well for us.
And another big business in the US is healthcare. And again, you have about 13% of the fund in healthcare. And when we spoke about a year ago, we talked about the potential for more effective radiology due to AI. So again, we talked about AI briefly already, but I'm just wondering, is that still where the fund is exposed on this technology side of healthcare, or do you have pharmaceuticals or something else in there?
Yeah, and here again, we have been able to identify various companies with great business models, well-managed companies in different areas of the healthcare space. So we do have investments in managed care. These are insurance companies like United Healthcare and Elevance, which are in the portfolio and have been in the portfolio for the long term. We also have, you mentioned pharmaceuticals. We have an investment in Merck, and we also have investments in tools companies like Danaher, which is a recent investment, phenomenal company, and also Agilent. And then we have investments in some medical devices companies like Edward Life Sciences, which continue to innovate and do very, very well.
Do you see more opportunities in healthcare now compared to maybe when we spoke a year ago or a few years ago?
So the opportunity set keeps on evolving, and we are constantly looking at new ideas and also evaluating the new ideas against what we already own. And oftentimes the companies we own are doing phenomenally well, and so the bar of entry into the portfolio is very high. So we always have a pipeline. We're always looking at names, and it's only when it aligns well with our philosophy of finding great businesses at bargain prices. Only then, that's when we make changes. And right now, we feel very, very comfortable with the holdings we have. But as I said, Danaher has a new name in the portfolio, which we added in the last quarter.
And I just wanted to wrap up with, it's an election year in the US. I've got my international ballot ready. It's still 6+ months away as we're recording, but do you find any difficulties in managing the portfolio during an election year, or is it very much status quo, same?
Yeah. So there's always volatility, and investors who are especially short-term in nature tend to move around their positions during an election cycle. But in my experience, the U.S. economy has continued to prosper despite who is the president or who is running the House or the Senate. So our bet really is on the long term on the U.S. economy. And we don't generally rejigger the portfolio based on an outcome of an election. My view is that the economy will continue to prosper over time, and we don't really overly focus on the elections.
Well, you said yourself, you're looking at the companies and you want to hold them for the long term anyway. So hopefully they're outliving any election cycle volatility.
Well said. Yeah. That's exactly right.
Not to put words in your mouth. No, that's brilliant. Maneesh, thank you for talking to me today.
Thank you. It was a pleasure.
This fund is unconstrained, meaning that the manager is free to select companies from across the market cap spectrum. This has enabled the fund to become one of the few to regularly outperform the S&P 500 over long periods of time, making it a strong candidate, in our opinion, for those looking for a core U.S. equity fund. For more information on the Brown Advisory U.S. Flexible Equity Fund, visit fundcaliber.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on Fund Caliber's research methodology and are the opinion of Fund Caliber's research team only.